Welcome to the channel. Today, our subject of discussion is rather very important, and that is decoding Japanese investment criteria. The Japanese investment matrix, that is, how multinationals in Japan choose where to invest. This is generally our video number 107. Regarding the Japanese investment matrix, that is how multinationals in Japan choose where to invest. When evaluating foreign markets, Japanese multinational corporations, that is MNC, trading houses, that is Sogo Shosha, and institutions like the Japan External Trading Organization, that is JETRO, and Japan Bank for International Cooperation use a highly structured risk mitigating framework. Factors which Japanese company consider before investing is a very interesting point for them. Unlike Western venture capital that often embraces high risk for explosive returns, Japanese investors prioritize long term corporate continuity and predictability. They evaluate potential host countries across five core dimensions. And what are those five core dimensions? You start with number one is political and macro policy stability, consisting of the factors like A. Continuity of laws. Can a new government overturn existing tax incentives or corporate structures? Suddenly, regulatory shifts are a major deterrent. B. Foreign exchange and capital control. Can the company easily repatriate profits to Japan? Currency volatility and restrictions on transferring US dollar out of country heavily damage investment scores. Number two, factors क्या है? Core criteria, that is market scale and growth trajectory, the pull factor. और इसमें पहला demographics. While Japanese shrinking populations, investors look for a demographic dividend. That is, a young, expanding middle class that drives local consumer demand. और दूसरा factor, strategic geographic access. Is the country an optimal export hub to broader markets like Thailand, like ASEAN, European Union, or the Middle East? The third important matrix is infrastructure and supply chain resilience, consisting of factor number one, that is logistics and utilities. Predictability of electrical grids, very important questions. Water access and ports. Or अगर the factories rolling blackouts, if the factories face rolling blackouts or poor road infrastructure, Japanese manufacturing efficiency breaks down. और ये पाकिस्तान से सबसे ज़्यादा related item. Key factor, local procurement rate. The ease of finding high quality local component suppliers who limit over reliance on imports. Chauथा M factors, that is labor quality and wage cost efficiency. And in this category, The first point is first factor is skill set versus cost. Japanese firms balance the minimum wage with the technical proficiency और substance discipline and retention rate of local workers. और उसके साथ वो कंसिडर करते हैं लेबर डिस्प्यूट्स. Historically risk averse, Japanese management carefully assesses the frequency of strikes, trade union volatility, and local labor litigation laws. This factor is very, very important, particularly in the context of Pakistan situation. पांचवा core factor, transparency and compliance framework. That is, कौन कौन पूरा राय छू. इसमें है A, clear bureaucratic pipelines, intellectual property protection, and minimal administrative friction. They lean heavily toward countries that establish single window investment platform like special economic zones. Let's now come to comparative chart evaluating Japanese investment potential. The chart below, the chart which we are going to discuss, compares India, Thailand, Indonesia, Singapore, and Pakistan across the core metrics tracked by Japanese investment bodies. Thailand and Singapore represent mature, low-risk hubs where Japanese capital has been deeply integrated, of course, for decades. As far as India and Indonesia are concerned, both these countries represent the highest priority high growth engines. Coming to Pakistan, Pakistan represents a massive demographic opportunity bounded by immediate macroeconomics bottlenecks. Here is a chart to discuss core evaluation metrics for investment. One core factor metric was market potential and demographic. As far as India is concerned, with 1.4 billion population, skyrocketing young middle class, and dominant domestic demand focus, scores as excellent. As far as Thailand is concerned, moderate aging population slowing domestic growth, acts primarily as an export hub. Indonesia, the population of about 275 million plus, largest economy in ASEAN with robust domestic consumption. As far as Singapore is concerned, it ranks low in this category because of domestic factor that is tiny local market which serves entirely as a regional commercial gateway. And as far as Pakistan is concerned, it scored very strong with 240 million population, fifth largest consumer market, vast young labor pool. Coming to the second factor, infrastructure and supply chain. India is developing fast with a major national logistic corridor, rapidly growing local auto and legal supplier, technology supplier base. Thailand score is excellent because Thailand is considered to be Detroit of Asia. Deep established Japanese supply chains for automotive and electronics. Indonesia is again strong with 275 million population, largest economy in ASEAN with robust domestic consumption. And As far as infrastructure and supply chain is concerned, it is good. Massive infrastructure push, expanding manufacturing corridors through island geography adds logistics complexity. As far as Singapore is concerned, it is a world class, it provides world class infrastructure, flawless logistics, advanced digital infrastructure, and global connectivity. Regarding Pakistan, the situation is challenging, facing industrial power, oblique energy bottlenecks, limited local component supplier base for advanced manufacturing and technology. Coming to the next four metrics, that is political and policy stability. India is stable, high policy continuity regarding digitalization, domestic manufacturing with the slogan Make in India. Thailand is moderate, occasional political restructuring, but deeply entrenched pro-Japanese investment policies remain unchanged. Indonesia is stable, predictable governance, friendly trade policies, though natural resource nationalism requires navigation. Singapore is exceptional as far as political and policy stability is concerned, with highest global score for legal transparency and predictable governance. Pakistan is volatile, frequent geopolitical shifts, and fluid economic policies create structural friction for long term planning. The next factor is ease of profit repatriation and foreign exchange. India, it stands good. It has structured but reliable capital outflow protocols with stable currency. Thailand, of course, is excellent, highly liquid, open financial markets, seamless flow of capital back to Japan. Indonesia is good, open capital account, predictable foreign exchange framework. Singapore, it is unmatched, not even excellent. It is a complete financial freedom, zero capital controls, the absolute financial hub for regional headquarters. As far as Pakistan is concerned, volatile, Pak- frequent geopolitical shifts and fluid economic policies create structural friction for long-term planning. And as far as ease of profit repatriation and foreign exchange is concerned, Pakistan is highly restrained. Severe foreign exchange reserve volatility and tight central bank curves create intense delays in repatriating profits. The last important core evaluation metrics for investment is current Japanese investor sentiments. For India, they have peak appetite, ranked as a top priority for investment expansion globally, surging commitments in manufacturing and technology. Thailand, it is a mature and stable market for them. Focus is shifted toward upgrading existing plants to EVs and automated logistics rather than new expansions. Indonesia, Japanese investors have high appetite, high investment in infrastructure, consumer goods, and clean technology transition. As far as Singapore concerned, it is a strategic hub used primarily to base regional holding companies, R&D centers, and VCR. And finally, as far as Pakistan is concerned, Japanese investors have a cautious interest because long-term standing Local players, autos remains profitable, but onboarding new Japanese capital is slowed by macro risks. Coming to the summary analysis for strategic planning, let us summarize. The first important point is Singapore and Thailand are safe havens for Japanese investment or Japanese investor. If a Japanese corporation wants zero operational risks, seamless logistics, and immediate access to ASEAN, they deploy capital here. Singapore takes the financial R&D weight. Thailand takes the heavy manufacturing weight. B category is India and Indonesia. That is, they are growth engines. These are primarily targets for Japanese corporate expansion. India's sheer market size and digital scale have made it the highest rated destination for Japanese manufacturing expansion. Now, Pakistan, it's a high risk, high reward frontier for them. Japanese company already inside Pakistan, like the major auto conglomerates, recognize its highly profitability potential due to low labor costs and vast domestic consumer scale. However, until the foreign exchange risk stabilize and structural policy consistency is achieved, major institutional Japanese capital will remain heavily cautious compared to its deployment in India or ASEAN. We are witnessing a fascinating, highly strategic, and necessary geographic rebalancing of Japanese capital. Japan is fundamentally a nation searching for economic anchors to offset its own domestic demographic realities. When analyzing how these factors play out across the five countries discussed as above, three overarching strategies themes emerge. That is, number one, the quiet shift, de-risking, and the rise of India. For a long time, China and mature ASEAN markets like Thailand were the default destination for Japanese industrial expansion. However, current global trends show that Japanese multinational banks and manufacturers are actively diversifying their portfolios. India is capturing the lion's share of their shift. The combination of political stability, a massive digital forward workforce, and the sheer scale of local demand makes it an unavoidable partner for Japan. Rather than purely speculative venture, Japan views its massive investment in India as a critical hedge and a long-term engine for its own economic survival. Next is the ASEAN playbook, the efficiency of ecosystem. Thailand, Indonesia, and Singapore demonstrates why Japanese investment thrives on interconnected regional clusters. Japanese companies don't look at these countries in isolation. They view them as a cohesive network. Singapore acts as a trusted zero-risk regional command center. Thailand serves as deeply integrated precision manufacturing hub, and Indonesia acts as the resource-rich, heavily consumption market. This ecosystem approach minimizes risk because if one country faces a localized issue, the broader regional supply chain keeps moving seamlessly. Finally, the Pakistan paradigm, high profit versus high friction. Pakistan represents one of the most interesting untapped frontiers for Japanese corporations, defined by acute contrast. between local performance and macro perception. The ground reality, as highlighted in bilateral summits like the Japan-Pakistan High-Level Economic Policy Dialogue and JETRO's latest data, Japanese companies that are already on the ground in Pakistan actually report solid profitability and medium-term expansion intentions. The long-standing presence of Japanese automotive and industrial firm proves that the market yields strong return once an operational footprint is established. But the bottleneck, the friction lies in onboarding new Japanese capital because Japanese corporate culture is deeply risk averse. Macroeconomics indicators, especially foreign exchange volatility and the complexity of profit repatriation, act as a heavily psychological barrier. Our final synthesis is Japanese investors are highly rational and deeply loyal. They do not abandon market easily once they establish trust. For mature markets like Singapore and Thailand, the relationship is stable and predictable. For Pakistan, underlying economic fundamentals, the young population and high consumer demand are genuinely attractive, but unlocking the next wave of major institutional Japanese capital depends entirely on the state's ability to guarantee long-term macroeconomic and stability and regulatory predictability. With this, we conclude our subject of today's discussion, that is decoding Japanese investors' metrics, decoding Japanese investment criteria with the bottom line. When Japan looks at a map, it does not see countries. It sees potential multi-decade partnerships, the nations that win their capital and simply the ones that make it easiest for Japan to see a stable, predictable future. With this, we conclude our discussion on today's topic. Stay tuned and do like, share, and subscribe this channel as soon as possible. Thank you and thank you very much.